Welcome. Today, HDIN Research presents a strategic deep dive into Indorama Ventures, IVL. We will analyze the group's transition from a decade of aggressive acquisition-led growth to its current IVL 2.0 framework, focusing on value extraction and balance sheet resilience in the 2026 fiscal environment. The core thesis of our analysis is IVL's pivot toward high-margin sustainability. The management is currently executing a four-pillar strategy: optimizing asset footprints in high-cost regions, enforcing strict financial discipline to lower leverage, and spinning off high-growth segments to unlock latent shareholder value. IVL's competitive moat remains its unrivaled scale. As the world's largest integrated pet producer with an 18% global market share, the group benefits from significant economies of scale and a vertical integration model that spans from upstream feedstock to downstream packaging. Geographic diversification acts as IVL's natural hedge. With 138 facilities across 31 nations, the company can mitigate regional supply chain disruptions and energy price volatility. We see a strategic emphasis on leveraging low-cost energy in North America while rationalizing older European assets. A key strength of the portfolio is its resilience. Approximately 70% of sales are linked to non-discretionary consumer essentials: food, hygiene, and personal care. This defensive profile provides a stable cash flow floor, even during periods of global macroeconomic uncertainty. However, the sector faces structural complications. Rapid capacity expansion in the Asia-Pacific region, particularly from mainland China, has compressed global spreads. Additionally, the energy cost gap between the U.S. and Europe continues to challenge the profitability of legacy EU operations. The 2024 results reflect a deliberate cleansing of the balance sheet. The reported loss of 19.2 billion baht was primarily driven by non-cash impairments related to asset closures. HDIN Research views this as a necessary step to remove high-cost drags on future return on capital employed. Leverage management remains a critical focus. The net debt/EBITDA ratio peaked at over 5.0x in late 2025. Reducing this to below 3.0x is essential for maintaining the group's investment-grade credit rating and reducing interest expense in a sustained high-rate environment. This brings us to the pivotal question: how does a volume-led giant transition into a value-led leader? The following slides detail the IVL 2.0 answer to this challenge. The solution is a triad of footprint optimization, asset monetization, and digital transformation. This is not just a cost-cutting exercise. It is a fundamental re-engineering of how IVL generates margin from its global assets. In footprint optimization, we observe a decisive move away from high-cost PTA and PET production in the Netherlands and Australia. By consolidating volume into more efficient hubs, IVL aims to lift global operating rates toward the 83% mark by 2027. The Olympus 2.0 program targets $450 million in annualized efficiency gains. The focus here is on AI-driven procurement and manufacturing excellence, ensuring that the group's variable cost structure remains the most competitive in the industry. Asset monetization is the primary deleveraging lever. The planned independent listings of the specialty chemicals and packaging divisions are expected to generate over $1 billion in cash, which will be directly applied to debt reduction. Indorama represents the high-value future of the group. Focusing on surfactants for crop solutions and home care, this segment offers EBITDA margins in the 16 to 18% range, significantly higher than the commodity polyester business. In the packaging space, Indorama leverages IVL's integrated feedstock to maintain a 20% EBITDA margin, outperforming its regional peers. The strategy here is to move further downstream into specialized segments like laminate tubes. The fibers segment is being repositioned to capture high-growth megatrends. While lifestyle apparel remains competitive, IVL is shifting resources toward the mobility and hygiene sectors, where safety and medical standards command higher premiums. IVL's footprint and ESG credentials are its primary differentiators. While regional players like Alpec have strong positions in the Americas, IVL's global reach and circular economy integration remain unmatched. Comparing the metrics, IVL leads in total capacity and recycling integration. Its set AAA ESG rating is a critical factor for global FMCG customers who are increasingly mandating sustainable supply chain partners. Sustainability is a core business driver. By recycling nearly 800 bottles every second, IVL is not just meeting regulatory requirements, but creating a premium rPET product that commands a significant price spread over virgin resin. Digitalization is the silent enabler of this transformation. Standardizing global operations on a single SAP/S/4HANA instance allows for real-time inventory management and a projected 15-day reduction in the cash conversion cycle. Looking ahead to 2026 and 2027, HDIN Research forecasts a robust recovery. As the benefits of the 2.0 pivot materialize and interest costs decline via deleveraging, we expect net profit and ROE to return to mid to high single digits. Finally, the strong governance and high promoter skin in the game provide long-term stability. The Lohia family's 66% stake ensures that management incentives are tightly aligned with shareholder value creation. In conclusion, IVL is at an inflection point. The transition from scale to value is well underway. For more detailed market research or specific sector reports, please contact the HDIN Research Advisory Team.